Welcome to the Explainer. Today, we're unpacking one of the most notoriously complex puzzles in financial reporting. We're talking about International Accounting Standard 38, or IAS 38 for short. We're going to take a deep dive into the incredibly strict and honestly often counterintuitive rules that govern the invisible engines of modern business.
Think about it. It's kind of the ultimate paradox of modern business, right? How does a company value something you can't even touch? We live in an economy where a company's most valuable assets, things like proprietary software, patents, and trade secrets, are completely invisible. You can't exactly lock them in a vault, yet they drive literally billions in revenue. So IAS 38 is the definitive framework designed to put a reliable, highly regulated price tag on these financial ghosts, basically ensuring that financial statements stay grounded in reality.
To make sense of all this, we're going to follow the complete life cycle of an invisible asset. We'll start with valuing the invisible, then move to the strict recognition test. After that, we'll look at research versus development, measuring after the fact, and finally, the asset's lifespan.
All right, let's jump right into Section 1, Valuing the Invisible and Defining the Intangible.
So before anything can even touch a balance sheet, it has to meet the core definition straight from the standard. It has to be an identifiable, non-monetary asset without physical substance. And this rests on three absolute pillars. First up, it must be identifiable, meaning, you can separate it and sell it, or it arises from some sort of contractual or legal right. Second is control. The company has to have the actual power to secure the future economic benefits and, crucially, restrict others from accessing them. And third, it must actually generate those future economic benefits, whether that's through incoming revenue or future cost savings.
Moving on to Section 2, the Strict Recognition Test, or, as I like to call it, IAS 38 as the bouncer.
I really want you to think of IAS 38 as the ultimate unyielding bouncer at the absolute most exclusive club in town, the balance sheet. This bouncer heavily restricts who, or rather what, gets in. Like, you might have the most brilliant, highly trained staff in the entire world. You might have incredible customer loyalty or this amazing internally generated brand. But here's the kicker. Without legal rights to strictly control those things, the bouncer says, nope, absolutely not. You can't control whether your best employee walks out the door tomorrow, right? So you cannot capitalize them as an asset. These rules are there for sure to ensure companies can't just artificially inflate their value with what basically amounts to everyday operational success.
Okay, Section 3, Research versus Development. This is the big divide.
So, what actually happens when a company tries to create an intangible asset completely from scratch? Well, this brings us to the big divide. Accounting rules treat the mere birth of an idea very, very differently from the actual building of a product. See, during the research phase, you're really just gaining new scientific or technical knowledge. And because there's absolutely no certainty that it's going to turn into anything profitable, every single dime spent here is immediately recognized as an expense. There's no asset yet. But once you cross over into the development phase, that's where you're actively applying that knowledge to a specific plan or design. Then you can start capitalizing those costs as an intangible asset. However, there is a major catch.
To get past that bouncer during the development phase, a project has to flash these 6 strict VIP passes. Let's dive into this. First, you need to demonstrate the technical feasibility to complete it. Second, you must have the intention, and third, the ability to actually use or sell it. Fourth, you have to prove exactly how it's going to generate probable future economic benefits. Fifth, you've got to show you have adequate technical and financial resources available to, actually finish the job. And finally, number 6, you must be able to reliably measure the costs. Listen, if you miss even one of these, like say running out of funding for step 5, you stay an expense forever. You do not become an asset on the balance sheet.
And this specific example, straight from the standard, just brilliantly illustrates how incredibly rigid this timeline is. Imagine a company is developing a new production process, right? And they spend 1,000 currency units over the course of the year. But they only manage to meet all 6 of those strict criteria we just talked about on December 1st. So what happens? Well, the 900 units they spent before December 1st are expensed forever. They are completely gone. You cannot retroactively reinstate past expenses. No way. Only that final 100 units spent after December 1st crosses the finish line and gets capitalized as an actual intangible asset.
That brings us to Section 4, Measuring after the fact, or valuing the asset.
Okay, so once the asset has finally made it onto the balance sheet, how do we keep track of its value as time goes on? Well, IAS 38 gives companies a choice between 2 pathways for ongoing measurement. The first one, and frankly the most common by far, is the cost model. Here you basically carry the asset at whatever it costs to acquire or develop, minus any accumulated amortization and impairment losses. Simple enough. The second option is the revaluation model, where the asset is carried at its fair value, which is supposed to be updated regularly by referencing an active market.
But here's a really surprising reality to keep in mind when you're analyzing these financial statements. While that revaluation model totally exists on paper, it is incredibly rare in actual practice. Why? Well, because IAS 38 strictly demands an active market. And guys, an active market for totally unique assets, like a very specific proprietary patent, or a historic brand, or exclusive music rights, it practically never exists. You can't just look up the daily market price for a unique patent the same way you'd look up a share of stock. It just doesn't work that way. Consequently, the vast majority of companies are pretty much locked firmly into the cost model.
And finally, Section 5, the asset's lifespan. Finite versus indefinite.
Because even invisible assets have a life cycle, these rules force companies to make a really crucial assessment. Does this asset have a finite useful life, or is it indefinite? Now, if it's finite, say it's like a patent that legally expires in 10 years, it gets systematically amortized as an expense over that useful life. Pretty straightforward. But if the life is indefinite, meaning there's literally no foreseeable limit to the cash it's going to generate, like maybe a world-famous historic brand name, it is not amortized. Instead, it has to undergo this incredibly rigorous annual impairment testing. This basically forces the company to prove every single year that the asset hasn't lost its value.
So what actually happens at the end of a finite asset's life? Well, IAS 38 has a remarkably stubborn rule for this. The residual value of a finite intangible asset is always assumed to be exactly zero. Seriously, zero. Unless a third party is legally committed to buying it from you or an active market somehow magically exists at the end of its life, accountants just have to assume it's worth absolutely nothing. It's a fascinating rule that forces immense conservatism about the future value of these invisible assets.
So, we've seen just how strict IAS 38 really is, acting as this uncompromising bouncer to keep financial statements grounded in cold, hard reality. But as we keep moving into a future that's entirely dominated by data, software algorithms, and digital platforms, you really have to wonder, will these strict rules need to evolve? Can our legacy accounting standards actually keep up with an increasingly intangible world? It's definitely a fascinating question to ponder as the whole business landscape shifts right beneath our feet. Thanks so much for watching this explainer, and remember to keep questioning what you can and what you cannot see on the balance sheet.